Thanks, Chuck. So hi, Mateo. Here doing a presentation on tax savings for data freelancers and founders. I became a financial planner because I was a freelancer and I was looking for a financial planner that I could just hire to give me some advice. I didn't want someone to manage my money. I just wanted them to, look it over and tell me what to do. Then I had some clients that actually made software for financial planners. So I learned about it and wanted to help other people live their life with purpose, understand, trade-offs of different decisions, and hopefully live good lives. So I'm very interested in how other people live their lives and made that my career. So a few disclaimers, compliance reasons, have to say some of this stuff. Financial planning, investment, tax advice is personalized. So, it's very difficult to say one thing for everyone. So it's best not to make any decisions without having a consultation with a professional, especially if you have any doubts with any of the scenarios and things, because there can be some torpedoes or pitfalls you might not be aware of with general advice. And then the tax advice is current for today. Technically, the government can make retroactive changes. They've done that in some cases, and it's for 2024. So if you're watching this in a different year, there might be some changes, especially in 2026 with the new elected officials and some tax code expiring soon. Slides will be shared and made for the intended audience, also a compliance thing. So I wanted to start off by just saying this is a slide that I had last time too, with the presentation I did, because I was at a networking event recently, and people were kind of dismissive of freelancers and things. I just want to remind everyone that's in the audience, freelancing is a business. View yourself as one. Prioritize your needs as well as your clients, but focus on you, because a lot of times people treat you as a contractor and sort of staff augmentation, not an actual partner or thought partner. But it's a real proper business and career path. So here's a lot of the value of tax planning, which is figuring out when you should pay taxes, avoiding certain taxes. That's totally legal, avoiding taxes. You just can't do abusive tax schemes that are a little bit not with the character of the law and things like that. So part of the benefit for data freelancers, entrepreneurs, is what I'm showing here. Let's say you get a job, you're starting to make more. These are your marginal tax brackets. So on each additional dollar, this is how much you're taxed on, maybe 22% or 12%. And as your income changes and you retire, different things start to happen. So if you're in a lower tax bracket, you might have no capital gains that you have to pay. That's when you sell like a stock or a capital asset, could be like a home. Generally, that would be a bigger number. But if you're in the 0% capital gains bracket, if anything you sell, you can get a higher tax basis because you're only taxed on what you bought it for and then what you sold it for, the difference. So there's some benefit in tax gain harvesting. There's also tax loss harvesting. So you're in a high tax bracket, you can actually deduct certain things. And then as a business owner, you can choose when to pay expenses to a certain extent. You can choose to, let's say you buy a laptop, you could take all of it as a tax deduction in this year with what's called a Section 179 deduction, or you could depreciate it. So, if you're in a high tax bracket now, or you expect to be in the same in future years, you probably are okay taking all that deduction in year one. But if you, aren't making much money yet, you're expecting to make more money in the future, maybe you want to depreciate that over lots of years to get better deductions. So there's a lot of different things you can do to help take advantage of, not paying 37% in taxes. Maybe you pay 12%, and on $1 million, 25% is quite a lot of money, 250,000. It's all about trying to look at your taxes through your whole life. One thing that happens later in life is these RMDs. They're called required minimum distributions, and that's where the IRS says, hey, you have a right retirement account. You have to take withdrawals based on your life expectancy. That's supposed to be for your retirement. So that's taxed as income, and it can push people up to a high bracket. That's why having a Roth account, which isn't subject to RMDs, can be beneficial. So this is a typical type of client where in their 50s, like late 50s, they might want to consider Roth conversions as they are in a lower tax bracket in those pre-retirement years. With an entrepreneur too, there's times where you take a sabbatical from work, maybe 5 years, you're not making much money because you did well before. Maybe you're coasting for a bit. That's when you could evaluate doing the Roth conversions. But at the end of the day, it's all about your goals in life, and these are just different tactics you can take to, go about that. Just a quick example of depreciation, not the most exciting stuff, but there's different methods for taking depreciation. That's where you can deduct the cost of something that you're using for business. I'm going to give an example of a laptop, $2,000. If you're to do that, I have a small typo here. I changed it from 1,500 to 2,000, but straight line 5 years on 2,000 would be 400 per year. I'll fix that when I send out the slides. But there's different schedules you can use for depreciation. You can take the immediate deduction, do the 2,000 like I mentioned, or you can sort of drag it out. And most of the curves are accelerated. So it wouldn't, the straight line would be best if you're expecting rising income. I wanted to use some latex just because there's some more mathy people in the background, and I wasn't even sure how to use the pi symbol properly with this one here. But I wanted to mention, Roth conversion, you pay tax now, and then you don't pay tax when you withdraw it. So this is what they call the tax equivalency principle. It's just simple multiplication. And it's easier to see this way. So if you pay the tax today, that's the symbol on the left, and then you have your investment returns. Those compound each year. That's why I'm multiplying. And then that's your terminal value, what you end up with. And then on the flip side, if you invest your assets, then pay tax, it's the same because math is, that type of algebra is commutative. That's sort of the basics. You try to pay tax when you're in a lower tax bracket, but there's also some benefits with Roth IRAs in terms of not having those required minimum distributions and other things. So TIE generally goes to Roth, but you're not doing terrible if you're in if you're doing a traditional IRA. Sometimes that makes sense if you're in a high tax bracket. It's not always good to do a Roth, and it all depends on your view of tax rates. And this is just an example of a Roth conversion using financial planning software. So you can see in the left here, this is income tax. This is someone who has an IRA. They didn't decide to do Roth conversions, and they have all this time in these years, sort of in between working. They have some assets, they're not having any tax. And the point of a Roth conversion is kind of to smooth the curve because taxes are progressive. So if you can reduce, or if you can use up those lower tax brackets, you'll reduce the tax in your lifetime. And financial planners use software to help estimate this, plug in your goals, figure out, hey, you're actually going to have a big expense then. Where's that going to come from? And trying to get closer to the optimal with taxes. So in this scenario, the Roth conversion, you're realizing some income in these middle years that you're not having any taxable income. Oh, in this scenario, it would save the person, $238,000. Just a little thing I whipped up, but it's all depends on the type of person. There's no guarantees with things in terms of investment returns, but there's a lot of potential for a financial planner to be useful when you're in a lower income year, like a transition period. Oh, also one thing that's unique to entrepreneurs is with traditional IRAs, that's the retirement account that anyone can get. There's certain income limits where you don't get a tax deduction. However, if you don't have a retirement plan at work, maybe you just started a business, you're single, your spouse doesn't have one, you can still get that tax deduction up to any income. So that's really powerful, and some people don't realize it. The other thing, you have until your tax filing deadline, so generally April 15th, to do that. So if you're like, hey, I didn't make enough money yet, but you're doing better next year, you can still contribute for the prior tax year until that point and get a tax deduction. So at the 22% bracket, if you contribute, say 6,000 or so, that would be, can't do math right now, 1/3, 2,000, I believe. Yeah, somewhere around 2,000, maybe, yeah. And maybe 2,200, 22, whatever. But yeah, so you can get some real tax savings at tax time if you're like, hey, I have this money, let me save it. And then there's other things like the savers credit that apply to people with lower income that, if you do a provisional tax return and free tax software, it might show you that. Or you could work with a tax planner, see if it makes sense for you to work with them by talking to them first, and they can help you see like, oh, if you do this, you're going to get an extra credit and a deduction. That makes it really powerful if you have the money to do it. Also, 401ks have Roth features as well. So there's Roth IRAs and Roth 401ks. There's something to be aware of. So I mentioned this. This is tax gain loss and loss harvesting. So like if you have a 0% capital gains bracket, for a single person, this would be somewhere up towards around $55,000 in income, pre-tax. You can realize capital gains at 0% taxes. So let's say you made a lot of money in NVIDIA. Not a ton of money because you're trying to stay in the 0% tax gain bracket. Let's say you get a $10,000 capital gain. You could realize that gain, move your assets into something a little bit more prudent or diversified, and not pay any taxes, just in that year where you have a low tax bracket. So it can be really powerful for that. Also, if you have losses in your portfolio and you're in a higher income year, you might consider tax loss harvesting, where you look through your individual positions and you say, I want to sell this one that was bought on this day, and I'll get a loss of $3,000. That deducts against your income. And this is the type of thing, especially when you're in transition year, or if you do have any assets, you're able to control these tax events. And it's something that can really save you some good money, make it worth paying a tax pro. And then there are some potential issues. If you misjudge things, you can pay taxes at an even higher rate. So this is where I'd recommend you work with a professional, or at least very closely look at tax returns, because the tax pro has software to run scenarios. You might model something in Excel or Free Tax USA. It's a little more clunky, but you could do it. Just be aware that there's some potential issues, and there's an article here you could read if you're curious about that. Another thing is HSAs. These are health savings accounts, and a health savings account is something that you have to have a plan that has a high deductible and out of pocket. Generally, somewhere in the range of $7,000 or $8,000 is the max out of pocket. So it's still insurance. If you have a major hospital issue and you owe $100K, you would mostly owe up to $8,000. But when you pick your own plans, you can pick one of these on the marketplace. Or even if you have a plan through your spouse, there's other ways to get insurance. And the benefit is you get that income tax deduction on whatever you contribute, so up to $8,500, a bit higher than the IRA. And then I did do math wrong last time. Oh well. So at the 24%, $8,550 is a reduction in $2,000 in tax owed. So that's some big savings there that help you contribute. And then the money grows tax deferred, just like a 401k. And then if you have any health expenses while it's in force, just the HSA, you could only have an HSA eligible health insurance plan for 1 year. But once the account's created, anything that has happened in that investment account, you can use those receipts. So let's say you bought expensive pair of glasses and went to the hospital today. 40 years from now, when your assets have hopefully grown, you can take that receipt, assuming tax law is the same, and withdraw that tax-free. So it can be a great retirement account that you can actually use a little bit earlier than IRAs. But again, there's some pros and cons in your situation. And then the other thing, you can wait until tax filing day to do this. So, if you're finally making some more money, this could be a retirement account you choose because of the instant tax deduction on your contributions. With some planning for next year, this is a little bit more important for freelancers, but I'll talk more about startups too. An S Corp is where you pay yourself as an employee, and then you also get distributions from the business. And figuring out if you should do that really depends on your income, how much you work, and some other factors with your taxes. And you should work with a tax pro for this one. Generally, if you're making, above 60,000, you're not working many hours, or you're starting to push above like 100, 150,000, and you're working a full-time schedule, then it can probably make sense. But it all depends on your state, and then what's reasonable compensation for your role. Because the IRS doesn't want you to avoid payroll taxes. That's where you avoid 15% in taxes by doing this strategy. And there's other limits and things that a tax pro would help you with. But definitely for freelancers, that's something you should consider if you're doing well. And you can elect to do it, after you've been in business for a while. So if you wanted to do it for next year, you should probably talk to someone soon to figure that out. And then you can always, do analysis and revisit it. For startups, generally you don't want to be an S Corp because there's limitations on how many investors you can have, and then the type of distributions you can do. There's a lot of restraints, and then there's some other issues with deductibility of certain things. So for a startup, you probably want to stay, an LLC or a C Corp. C Corp is the ideal structure, but there's some certain taxes that maybe it's not the best thing to do when you're just starting. This is just on the tax side, not the legal side. My advice here. Recommendation for startups. Real estate is the big issue for an S Corp. If you're a consultant that wants to buy a building, it might not be the best to do that with an S Corp, but that's where a tax pro can help you. And if you're doing really, really well, that's more for freelancers, defined benefit plans, so you can actually contribute, $275,000 into retirement accounts, which is huge. Otherwise, there's other plans like I'll talk about shortly. Okay, and those retirement, I'll talk about that more in a second. Here's a fun thing about taxes. I don't know if you've heard of this, but there's a requirement from FinCEN. It's an organization with the U.S. Treasury, where you have to report who owns companies that are registered with the state. And there's a few other types of entities like irrevocable trusts that I believe are required to do this. And the fun thing with taxes is they told everyone you have to do this, 500-day penalties if you don't do it by the end of the year. And just recently, a federal judge seemed to stop it. But I would still recommend you listen to this and maybe just file it just in case they change things. It's not a very difficult filing to do on your own if your entity is simple, like you're single or you and your spouse work in a business and you have an LLC. So generally, you just have to go click this link. It'll tell you how it works. You can file. It would take about 15 minutes just to say who owns what. Generally pretty simple. If you think you qualify for an exception, I'd probably recommend you work with an attorney there. Or you could monitor this case, but me monitoring cases as a tax professional, this is a little bit more in the legal advice realm, in my opinion. So, if it's really easy to do and you might avoid a lot of penalties, I would just do it. Okay, so a solo 401k, this is a retirement plan. If you're a solopreneur or a freelancer, this is something that gives you higher contribution limits than a SEP IRA. If you've already also contributed to a normal IRA, an HSA, and you still have more money you want to contribute, you're not quite at the level of a defined benefit plan, which has a lot more restrictions or rules about them that can be costly. You're in that in-between zone. This is where this retirement plan really is useful. And there's some benefits in the tax code now where you can get a credit if your plan has a provision for automatic contributions. So this is the website of people that help you out with that. They do charge a fee for creating it, but in my opinion, it's pretty reasonable. And this retirement account is great for someone that's just starting to do well with freelancing beyond the normal retirement accounts. They want to add more things. There's some ability to make contributions up until your tax filing deadline with extensions. So if you're not familiar with that, you're able to extend your taxes by 6 months by just filing a form. You still have to pay whatever was due at the original tax time, but you get more ability to do things. And this is one of those things that you could actually decide to contribute to a solo 401k up until October 15th, potentially. Now, you can't do all the contributions that you could do if you did it by the end of the year, but it's something pretty exciting. There's also a similar ability with SEP IRAs. So even if you don't get the time to do stuff by year end, there's opportunity here to extend to do things later for the prior tax year, and then you can double contributions once you're making enough money. But yeah, so I always recommend people extend their taxes. Some people get really upset about that, but the goal is not to get a big refund, and to wait until either people change things like that BOI reporting, that beneficial ownership, or take advantage of your option to contribute more later through things like this. Now, these are just some key deadlines. I'll just highlight a couple things here and not go through the whole list. So taxes that need to be paid by the end of, for tax year 2024, if you pay those through withholding, so like on your W-2 or even a distribution from a retirement account, if you elect withholding, gambling winnings, that's another way. It's treated as if that was paid throughout the year. So if you've been skipping your estimated tax payments, the IRS needs you to pay, quarterly for these as a entrepreneur. This is a way to get treated as if you were making those. So the deadline to not do that is the end of the year. And then anything that needs to be in a certain tax year, tax gain loss harvesting, depreciation choice, buying an asset, you're like, hey, should I buy that laptop this year? Should I wait till next year? Or a really fancy graphics card that's worth $10,000. If you do that next year, it'll be next year. So lots of pros and cons there, but you got to do that in the tax year. And then the other deadlines, estimated payments. Most people wouldn't do this, but if you have an S corp, there's W-2 filings. There's also 1099 filings that you have to do if you paid someone, like an attorney or something like that, if you paid them in cash. And then there's the business deadline. That's for like an S corp or a standalone entity like that, C corp. And then if you have a single member LLC or individual tax return, that's April 15th. And then you have to extend by that time too. State level, you might have additional requirements on extending. Generally, they follow the federal government with things. All right, so this is a tax plan. Anyone watching this, I'm happy to say you could go through this whole list yourself and do these things, or at least think about them. If you're ever like, this is getting too complicated, you might consider talking to a tax pro. I offer free introductory meetings where, I can tell you it doesn't make sense to hire me, point you to some resources. So you need to start with prepare a provisional tax return. I do this every year. I used to do it, in Excel, but now I have tax software to help me with this. And this will help you figure out where you are in those tax brackets. Are you in the 0% capital gains bracket? Should I do this? Should I do that? This is, you want to make sure you know that information. You want to make sure you're not owing any penalties, or at least you're aware of them with your taxes. So should you do that withholding I mentioned in the prior slide, etc. Same things as the other slides a bit here. The other thing I wanted to highlight is where you file. So, maybe you don't feel like using a tax pro, you'd rather do it yourself. My recommendation to most people is Free Tax USA. It sounds like a scam. People always think the website is weird, But it's a very legitimate website. I think they even have some IRS partnerships with things, and that's who I'd recommend you use. Their state filing is very cheap if you do have a state income tax return. In TurboTax, they're interesting. They charge you for the filing, and then when they do the refund processing, they make it sneaky where they might charge you an extra refund processing fee, and then your tax prep fees are a lot higher than $180 instead of $30 with Free Tax USA with a state return. Also, I do a lot of volunteering with the AARP Tax Aid, and this program is free. You don't need to be a senior to qualify. We work with some small business owners too. And, you can get your taxes done. A lot of times there's people like me there who are an actual tax professional. Some are retired people, and they can give you some free advice. Generally, they just focus on the tax, but it is another option where, get your taxes done for free. Also, there's VITA sites. They generally have a little bit tighter limits. That's IRS sponsored. Tax Aid sort of like a separate sponsored program from the IRS. A little bit different, but totally would recommend looking into that. And like I mentioned, you can reach out to me if you want to see, does it make sense for you to hire me? I wouldn't recommend you hire me if, I'm not going to save you money or do something useful for you, but I do work on providing personalized advice on an hourly basis, just like a freelancer. So I try to focus on just what you need and not expensive recurring fees, one-time project type of thing. And act now to minimize your taxes. Gets a little salesy, but really this is the end of the year. So this is more details on booking a meeting with me. I also have a financial planning newsletter, and happy to take any of your questions. Oh, also, if you need a referral, something that's not a good fit, I'm also happy to help you navigate the landscape of financial planners, tax people, et cetera. Try to give you a referral there too.
Well, thanks for the awesome talk, Mateo. I'm really curious about the estimated payments because I have totally skipped all of those. So I didn't fully get like what you're saying, but it seemed like there was a way to avoid penalty if I submit by a specific time.
Yes, it depends on there's a couple things there. So the IRS, and you're in Texas, so you don't have state tax, so you're good there. But the IRS takes what your taxes were last year, and they apply, some percent. So it's could be 90% of your current year tax, 110, or I believe it might go to 120% of your prior year tax, and that's how much you have to pay to avoid a penalty. Now, for someone like, I'm not sure your business structure and things, but
single member LLC.
Okay, and not an S corp or anything.
No.
So your options to do withholding are somewhat limited unless you're to do, like a taxable distribution or have big gambling winnings, where essentially you get a 1099 form. Anything that you get, like, interest, even like if you have a cash account, like at Ally Bank with interest, you can elect to do withholding, and any of that withholding will count as if it was paid throughout the year. So the penalties aren't generally that extreme, but if you can avoid them, that's great. I would just see if you have any 1099 options, and are you married too?
No.
There's not the most options for someone like you in that scenario, unless an S corp would have a little bit more.
Oh, I see. So I guess if I pay myself through my single member LLC, do I just treat myself as like a contractor or something? Like give a W-9 and fill out a 1099 form?
No, with that one, payments to you are treated as what's it called? Self-employment income.
Okay.
And there's a special form on your taxes, Schedule SE is what it is, Schedule of Self-Employment. And it takes your Schedule C income, that's your single member LLC, where your income there will be reported. That's where you put up, I can pull this up real quick. So this is Schedule C. This is profit or loss from a business. And in here it has, your income, your profit, gross income, et cetera. And do you have a business bank account? Or
Yeah.
Okay. So, when you pay yourself in the business bank account, or really when you receive any income in there, it's still treated as you getting it. It's called a pass-through. So, your income after any expenses, depreciation, other things, that will get reported on your Schedule 1 and your Schedule SE. So the SE is where the taxes come in. So as a single member LLC, you're going to be taxed generally about 15.3% on any dollar, plus the ordinary tax rates. So that'll help you figure out your current income and then taxes. And then that's one of those numbers I was mentioning for the penalties. So it's either prior year tax or based on your current year tax. So there would be a small penalty then. I say small, it depends on, the numbers, of course. But, if you use tax software like Pre-Tax USA and enter this in, they will ask you if you made any estimated tax payments. You'll tell them, did you make it by this date or before, et cetera. So, if you didn't do any of those things, you want to do that by January 15th.
Okay.
If you don't have any withholding options to do things, because that's the next date where all your contributions or payments count. They don't care if you do it in between, October, September, and January 15th. It's all treated as the next one, unfortunately.
Oh, interesting.
It's like thresholded.
I like this Free Tax USA. I didn't know that was an option. I guess TurboTax, they got to pay for those advertising dollars somewhere.
Yeah. Sorry, just pulling up one more thing I forgot to mention. If your income's lumpy, there's some other options you can look at as well. This is the form that you input all that information. But Free Tax USA would help you with filing. So if you made more money in Q4 and not in Q1, the IRS doesn't want to treat it as if you made it throughout the year. So
I feel like that's another question for, especially for like freelancers, because like you said, like maybe you're just like killing it for like a year or 2 years, but then you want to like kind of slow down for 6 months. You mentioned like an S corp was good for freelancers, but are there any like downsides if your income is lumpy to having an S corp, or does it really matter?
It doesn't matter that much. It depends on, when you work. So if you're working 40 hours a week and you don't have any income to pay you, that can be a potential issue.
Okay.
But if it's freelancing where you're paid, based on the hours you put in on some project, generally the hours that you work, that's what determines that reasonable count figure will come in. So you have to pay yourself a wage throughout the year. That's the issue with an S corp.
Mm-hmm.
And as long as your time is tied to that wage, you won't really have an issue if it's lumpy.
I can't imagine a situation where someone would be working as a freelancer but not getting paid.
Yeah, exactly. So freelancers, it should be good. It's more like a product. You start a product and you might not get paid. Your time's a little bit off until you're in more of a steady state.
Okay. Another question I had was like, my fiance and I, we want to get like real estate, but to do like Airbnb rentals with it or something like that. If we lived in that condo or something, like could we have it as like a business asset and like have it as a write-off, or do we have to have have it as residential because we're living there?
Yeah, you have to calculate the percentage of business use and other things. Generally with that type of thing, the biggest tax advantage you could do is, if you live in it 2 years, then if you ever want to sell it, you get a capital gain exclusion of up to $500,000. 2 of the last 5 years is the thing. So that's generally the bigger thing to do. So house hacking, they call it. You live in one of the units. People do multifamily, and they'll use that capital gain exclusion. That's why they stay there for a couple of years. Otherwise, if you just have a normal business, same sort of will apply with utilities and all that. One thing you can do is the business use of your home. But the big issue there is it has to be exclusive use, and most people don't actually realize that. So, if I can't use it for my own home office because I guess I'm learning math or other things. I'm playing video games in here sometimes.
Mm-hmm.
So it's not exclusive use, therefore I can't use this space. But if you're like, hey, I want to buy this place, I want to make a dedicated studio just for it, there's some tax incentive there if you actually do it the right way. So you get an extra room or something.
Yeah. Could you do that with like, if you live in like apartment complex, you rent one unit to live in and you rent another unit for like your home office or something like that?
Yeah.
But okay, so you don't necessarily have to own the thing. You can be renting it and it's expensive.
Exactly.
But do you have to like put the rental in the business's name, or can you put it in your own name and still do it that way?
Really, let's see. So you would have pull up another form. So this is income from a rental. I have to double check on a business rental because I haven't actually filled out this form for that. But what you would generally do is have the business pay rent to yourself, and you would want to make sure the values are like an arm's length transaction with a market pay.
Interesting.
But there wouldn't be that much benefit for that in most cases. It can get a little funky with. There can be some if it's like a bigger thing, and depreciation and all that can happen. But
But there's no way to like have like an office and then you just like sleep at the office and still have it as like 100% business use because you're sleeping there, or it doesn't really matter?
Not that I'm aware of. If you're like Elon Musk sleeping under the desk, I think that actually can count, but I'd have to double check on the technicalities there.
Okay.
That would count, like sleeping at Toyota or Capital One, they're still able to treat that as a business. So
Right.
I'd have to research that a little more.
Yeah, it's interesting. I feel like another big question is that like financial planning is
Mhm.
really hard for freelancers and founders because we have no idea what our income's going to look like next month, let alone next year sometimes, especially in the early days. Like
Yeah.
I can kind of make the assessment that, okay, I probably make a lot less money now that I'll probably make in like 10 years. I can make that judgment call, but I'm not sure what the line is going to look like until then.
Yeah, and that's where, there's only so much planning you can actually do. So the financial planner will work with you to come up with some reasonable estimates, error bars, different thresholds. So this is something, I don't know if you've seen this before. Let me see if my link will work here. This is something, I use for myself. I'm freelancing and I use a similar approach today to manage my cash flow. But this is just trying to plan for when you have variable income streams and trying to, account for the risk correctly. So this is saying I have these revenue streams over here. I have a big client, a small client, and I'm starting a product selling hot sauce. So, if all that's panning out, I'll make $4,300 a week. And then that'll flow through over here. And I can see why that is the difference. Oh, this is after expenses, I believe. So in here, we can have a company budget. This is contributing to retirement accounts. And this is what planner would be like, okay, we're going to model you spend all your money, but you contribute to retirement. And then there's the okay budget. You're still paying, deferred maintenance expenses. Your car isn't broken and stuff like that. You're still able to get by, but you're not like crushing it. And then the ramen budget, that's, you're just trying to get by as little as possible because you believe in the future. So, a planner would work under these different scenarios and help model, here's what it looks like under each. And then also can take a step back and say like, hey, you've actually done really well. You can afford to take a few years here. And it looks like your overall plan is still on track. But, look out for these things, maybe tighten up your budget here or experiment with these other pieces. So what I'll look at, for myself is, okay, how dependent am I on that big client?
Right.
I'm too dependent. If I lose them and I can't survive on ramen, that's a problem. So you want to, you can look at your income streams this way, assign probabilities, mix and match. And yeah, the planner would help you sort of understand a little bit too, zooming out, a little third party unbiased, some of the financial prospects of your activities too.
And then what about savings? How do you kind of think about that or incorporate that to these kinds of calculations and plans?
Yeah, I like to start by looking at the big picture. So first off, did the person save enough for a reasonable retirement? Let's say they can spend enough or earn enough to live until they want to retire. Does that look okay at this stage? And then after that, help them decide, is this someone that wants to spend a lot of money in the future? Figure out their goals. Do they want to buy a house? Do this, do that? And then put those in there to say, hey, if you're spending this much money and your business is not doing that great yet, you're not going to be able to buy that house. So help people sort of plan out their income and then see, did they save enough? For freelancers, there's some argument to have a big emergency fund, but once you have enough income streams, what really matters is how much money you have if you have an event that's adverse to you. So, the worst thing would be disability insurance. You can't type anymore. I actually broke my right hand once. That was, I think I was still able to freelance, but that was potentially scary. If you're in the hospital, you lose everything. So that's something that if someone can afford it, it's generally a good idea to have. If they're dependent on their own income and they don't have much else. But yeah, I would look at, burn rate. So if they're not doing well enough yet, how many months do they have saved? Are we getting below 3 months or 6 months? Can they increase any of these other streams here? How long will it take them to get back in the job market? Retirement picture, emergency big picture, and then figuring out that middle for all their goals. Because financial planning is all about helping people realize goals. Doing the most optimal thing tax-wise in this, it's impossible because income is uncertain. But you can do some broad strokes that really can still help people.
Mm. And I'll make this the last question, and then we can wrap up here. But so for me, I feel like when I quit my full-time job, I just like pulled everything out of retirement because I'm like, okay, well, I just got to make it work now, and I'm sure I'm gonna make more money in the future, and then I can have retirement in the future. Like, I don't know. At what point do you think it makes sense to have a retirement fund, and then do you have to like keep up a certain like contribution? Like, can you just like, if your income is lumpy, can you just like not contribute to a retirement fund for like 5 years or something? And then just like come back to it? Like, so I guess I'm just ignorant about like retirement funds because I just like pull all my money out of it.
Yeah, and as a planner, I would tell you, look at your risk appetite. How confident are you in your long-term plans? Because at least the approach I've used in my life is make enough early to coast. So as long as I don't touch my retirement accounts, I should be okay.
Okay.
But that's how I've solved it. But again, it depends on your risk tolerance. What I would recommend as a planner is, let's say we're using what some people treat as reasonable returns. You won't get too carried away with that. But let's say you have $1,000 in a retirement account. You're 30. You want to retire at 70. This is actually, let me put a higher number here. It'll be a little bit better. Let's say 50,000. You've worked for some years. So the future value of that compounded interest in a retirement account, grew from 50,000 to 750. So that's quite a lot of money there. Whereas if you were to, wait 5 years, it goes down, 250,000. So that operating opportunity cost of the compound interest, that's how Warren Buffett is so rich, is pretty huge actually. But if you really believe in what you're doing, investing in yourself can also be a great bet. So it's something you have to be aware of, the trade-offs, and then be honest with yourself if you're not panning out on your hopes and dreams as much as you can, because, ideally you would still have, I don't know, there's pros and cons. It all depends on your risk appetite. But there is a huge opportunity cost of not investing early.
Yeah, I really like the way you framed it here. I mean, everyone, I'm sure all the data entrepreneurs know compounding interest, but the way you framed it here, we're like, basically, I would need to make extra $250,000 over a 5-year period for it to like financially make sense to not have a retirement account, because like that's essentially what I'm foregoing by waiting 5 years to start putting money into a retirement account. And I feel like, that's very, because it's at like 50 grand a year.
This is just 50,000 total in the account. Yeah.
Right. But like $250,000 over 5 years,
Oh yes,
50 grand a year.
exactly. Yeah.
Yeah, I guess it goes back to your risk appetite and your optimism. So I guess I'm pretty optimistic. But I guess even if it doesn't work out, it's not like you'll never get that $250,000. You just have to wait an extra 5 years. So instead of getting it at 70, you get it at 75. And also the world might look a lot different in 40 years. So like, and if you're taking care of yourself, maybe you're not, the life expectancy goes up and you're living a little longer as well. So I guess optimism in many forms.
Yeah. And then, what's it called? And if your income's lumpy, you can still contribute, 5-6 years from now, see what that looks like. And if you're contributing, maybe you can contribute 25,000 a year starting in 5 years because you invest in yourself. That'll help you catch up great too. Then I'll just say, in my career, I think I told myself, if I spend $2,000 on books a year, it's kind of absurd. Now I go to the library a lot more, but I was like, I can use that to get a raise or boost my skills by, I don't know how many dollars an hour that is nowadays, but it's totally worth it. So there's definitely some benefits to investing in yourself. But, as a planner, it's sort of, you can show the range of outcomes, but at the end of the day, and see if it's reasonable, the belief in yourself. Have a real talk if the planner doesn't think so, but at the end of the day, no, you're the one making that decision. The planner just helps you get educated on the trade-off.
Yeah, this was awesome. Well, thanks for coming on again, kind of educating us on all the different things that you should know about when it comes to planning your taxes and all that. My big takeaway is now I have Free Tax USA, and I'm going to file before January 15th, and hopefully I can get around some of those potential penalties if I file a little later.
And then IRS.gov, make an account, and then you can pay your estimated payments directly on here. This is the best way to do it. Otherwise, the IRS will lose your payment, and you'll have some fun. So
I'm gonna write that down.
But IRS.gov, that's the website. Thanks for having me, and thanks for joining too for us. And
well, let's thank Matteo once again. Let's see, we have an event coming up next week from Basel. He's going to talk about the 5 things he learned from his failed data product. So if you are considering building a product or you're in the product development process now, I think that'll be a very interesting and valuable talk for you. And with that, thank you guys so much for your time, and we'll see you in the next one.